Yo, what's up you guys? Welcome back to another video, and in today's video I want to explain to you guys what interest rates are, how they work, and how you can apply them in the market as well. Now, if you're new to the channel, a sub would be appreciated as I provide valuable educational content on a daily basis, and if you do enjoy the content, please do consider hitting that thumbs up button as well. Now, what I do want to explain to you guys basically is that because we're stepping into a new year, what we tend to see is we get this thing in the market called rate decisions. It's federal funds rate or rate decisions. Now, basically what this means is that the market, the Federal Reserve, or, they come out and they have a discussion about whether they're going to hike interest rates or not. This message comes from the central bank, which is then passed on to the bank, and the bank passes it on to the borrower, which is you, me, which is the bank is the lender. So if you've ever taken out a car loan or a car finance, right, and you see your car selling for 100,000, but after you've done the paperwork and they tell you, would you like to take it on finance? It's basically you saying, I would like to buy it at this price, but you can add interest to it. I think prime is sitting at 30.5%. Just correct me if I'm wrong, because I don't have any debt. So what that basically means is that you get a car for 100,000, the bank then slaps another 150,000 on top of that. The interest that you pay on that would be 150,000. Why? Because the bank is a business. They are a financial institution. Basically, they've got bills to pay and people and salaries to pay. So they have to make a profit. They won't just give you their money and let you go away with it. No. They allow you to pay interest, and the longer they can get you to pay interest, the more you pay at the end of the day. The shorter the interest term, the shorter the loan term, the less interest you pay. The less you pay for borrowing the money from a FSP or a financial services provider. Okay, now that is what interest rates are. Interest rates is very easy. I give you a lemon, I tell you, give me 2 lemons back if I give you this lemon, but I want it by the end of tomorrow. The interest charge on that is 1 lemon. Now, then we have the concept out of the way. Sorry about that, my good friends. I'm just coming down. Just came from flu, so I'm just recovering from flu. So now that we got that out of the way, how does that work in the market, right? So basically, when inflation is high, now why does inflation get high? If you remember back in 2020, around March, when the pandemic hit, when the coronavirus came from that side of the world and it came over, like boom, COVID hit, everyone was put into their homes, on their houses, like Jacob Zuma would say, their houses and their homes. Basically, everyone was put back into their homes, right? Then, people were stuck at home. They had nowhere to spend their money. Okay. Then, as soon as the market started opening, what the feds did was the feds went and took interest rates all the way down to 0. Now, as a consumer, what do you do if you see something is on special? You go like, this thing is on special. What do? You spend, because why? It is free almost. So because the Federal Reserve had lowered interest rates to 0, thus encouraged consumers to spend money. And that is why we saw the CPI was sitting at an all-time high. CPI equals consumer spendings. CPI is an indicator that is used by investors to measure inflation. Because the Fed came in, lowered interest rates to 0, people went crazy out there and they started spending a lot of money. Then the Fed's like, whoa. Now things are getting out of hand because we're working with supply and demand. Now they're running out of supply, and now we've got a little problem on our hands. So people went crazy and all of that stuff because the interest rates were low. South Africans went out there and they were spending. Americans, people in Europe, everybody accumulated debt that they never knew were going to hunt them in the years to come. Fast forward 2 years later, today, the interest rates is now sitting, and this is just for the US, is now sitting at around 4.5. Now what do we have? You have consumers who has taken on a lot of debt at a 0% interest rate, right? Now, I want you to close your eyes and I want you to visualize and I want you to think of it in this way. You have taken out 100,000 Rand worth of debt because you didn't have to pay anything on it. 2 years later, they tell you, my friend, you went crazy. You were spending. You were spending the money like it was yours, like you worked for it. And then you wanted to run to Dubai, but you decided not to. But you were spending money like crazy. And then the feds come and they say, guess what? You're now going to have to pay us back 4.5% of that. And you go like, but whoa, I have never budgeted for this. What the feds are trying to do is they are trying to bring this high inflation that was caused due to low interest rate. Okay. Let me just do that. High inflation. Okay. Keep in mind the CPI is an indicator, consumer spending index, that measures consumer spendings over a period of time. This indicator is used to measure inflation. So if interest rates are low, consumers are spending, that means inflation increases. Now, the feds then have to cool the market down. So how do you bring this inflation down? You have to give people debt. The only way consumers spends less is when they've got more debt. So what happens now is the feds increase interest rates. This discourages consumers to spend as they now have more money to contribute towards their debt. The job of the feds at the moment is to bring down their sky-high inflation. And the best tool that the feds have to their disposal is interest rates. Now, the only way they can lower inflation or lower the CPI is by hiking the interest rates back, because lowering the interest rates was the reason why inflation was so high in the first place. Now, keep in mind the zero interest rates. Now, we're going to go back very quickly. Yeah. This is where interest rates were dropped, right about there. So this is where the feds went and lowered interest rates to zero. Now, this is the dollar index. Now, the dollar index went to a negative interest rate, right there, zero. Okay. Then basically what that means is investors were like, we're not going to invest in a currency with almost no return because of zero interest rates. And we saw the dollar index fell tremendously. However, what we noticed was, let me just remove this, a special tool used by Instagram traders to change their stuff. Okay, let me just remove this. Yeah, it's the second time I record this video. The first time I recorded it, the screen was not recording, so I had to re-record it, my friends. So what we saw was the dollar index dropped to the floor because of zero interest rates. And the reason why it dropped, because investors saw no reason to invest in the dollar because the interest rates were low. Then, since March 2020, we saw the stock market increased in value. Why? Remember, low interest rates, higher consumer spendings. Consumers were spending a lot of money. Why did the NASDAQ increase in value? Because the companies listed on the NASDAQ is a composite. It's made up of the 100 top tech companies listed in the USA. Apple, new iPhones, Amazon, packages being delivered. and people were spending left, right, and center. Then what happened? Then the Feds was like, okay, guys, you are going out of control now. We were just joking with the interest rate decision, but you guys are going crazy now with your spendings. It is time to lower, it's now time for us to work on how we're going to reduce inflation. So what does the Feds need to do? Remember, the whole problem started with a 0% interest rate, right? Zero rate. Zero rate had people running up and down to spend a lot of money. Now the Feds had to come through. The only tool at their disposal was the one who caused the problem. So now the Feds are slowly but surely hiking interest rates, one by one by one. And you can see over here how the Feds had been hiking rates month over month. And you can see how the dollar index recovered as the Feds started hiking interest rates month over month. You can see how the Nasdaq started losing value month over month as the Fed started hiking their interest rates. This applied for the Dow Jones, the S&P 500, as well as precious metals such as gold and silver, which is negatively correlated with the dollar index as well. This is a graph. This graph shows us how the Feds hiked interest rates. This is the interest rate here versus the S&P 500. And you can see here in January, as the Fed started hiking the interest rates, you could see how the S&P 500 started moving to the downside. Now, this is basically how the interest rate works. So as soon as you see the Fed's lower interest rate, then you can expect consumer spendings to increase. This means higher stock market, higher gold, lower dollar, because that means interest rates are low. This discourages investors to invest. Lower interest rate encourages consumers to spend and investors to not invest. Higher interest rate discourages consumers to spend and encourages investors to spend. Sorry, I hope that makes sense to you guys. But that is how interest rates work. It is important that you always keep your eyes out on the interest rate. But as the interest rates are increasing, you can expect the dollar index to increase in value. And this is basically the federal funds rate. Next video, we're going to speak about how does the NFP work as well. Guys, thank you for your time. I really appreciate it. Please do keep safe out there. And as always, cheers for years.